Hi guys, it's Stock Curry, and in just a few short weeks, we're going to be starting the Moomoo Millionaire Club Challenge. In today's video, I'm going to go over the 7 rules that we're going to follow in order to become a millionaire in the stock market. But before we get to those rules, I want to show you some math and some history to show you that it is in fact possible to become a millionaire in the stock market starting with just $2,000. As you can see here on this compound interest calculator, starting with just $2,000 and then adding $433 per month. By the way, that figure there is if you take the $100 per week that we're going to be investing or $200 per paycheck that we're going to be investing, it works out to be $5,200 per year. And if you divide that by 12, you get $433 per month. That's going to be the amount of money we contribute each month on average. You go for a length of time of 10 years with a 45% interest rate, and I know that's quite high, but just stick with me. You would become a millionaire in just 10 years. Now let's say we did this with a more reasonable interest rate of 30%. And yes, I know 30% might seem unreasonable, but stick with me and I'm going to show you why it's quite reasonable. If we were to do that, we would all become millionaires in just 14 years. So as you can see, you can become a millionaire starting with just $2,000 in the stock market. It takes time, 10 to 15 years, depending upon what interest rate you are able to get overall. And if your overall interest rate is lower, say 20%, it could take as long as 20 years. Regardless, you can become a millionaire starting with a small amount of money. Now, I want to talk about these interest rates, these overall rates or gains or returns, whatever you want to call them. And I want to look at why a 30% rate of return is in fact quite reasonable, and we might even be able to achieve more than that. From 1965 through 2021, Berkshire shares generated a compound annual return of 20.1%, almost double that of the S&P 500. Now, most of Berkshire's outperformance came earlier in Buffett's tenure when he racked up huge gains. Now think for a minute why Warren Buffett was able to rack up huge gains early on in his career, but later on it becomes a lot more difficult. The reason is when you have a small amount of money starting out, you can invest in pretty much any company you want. You can invest in penny stocks, micro caps, small caps, mid caps, large caps, it doesn't matter. You have your choice of what you want to invest in, so you can pick the stocks that have the highest possible return, buy those, and make huge returns. But once you start getting a lot of money invested, $1 billion or more, then you have a problem, because you can no longer invest in these micro caps and small caps. The problem now becomes that even if you were to take just 1% of your portfolio and put it into a single stock, you could literally end up buying out the entire company, because some of these small caps and micro caps, their entire market value is less than 1% of Warren Buffett's portfolio. So Warren Buffett at this point in his life is extremely limited on what he can buy. He has to stick to the large caps, mega caps, and in some cases, mid caps. If he invests in any company that's smaller than that, he ends up basically just buying out the company because he has so much money. However, as an investor with a small account, like Warren Buffett was when he started out in the 60s, you have your choice of what you can invest in, so you can invest in companies that generate a much higher rate of return. And that's what we're going to do. Now, I want to show you what Warren Buffett's rate of return was early on in his career to show you what's possible with a small account. In the first 11 years, Warren Buffett achieved a 30% annual return. Remember, starting with $2,000, putting in just $100 every week, and generating a 30% annual return, we will all become millionaires in just 14 years. Warren Buffett's first company was called Buffett Partnership Limited. The company lived from 1957 to 1969, And during its lifetime, Warren Buffett managed to reach a whopping 29.5% average return year over year. So if Warren Buffett did it, surely we can too. Warren Buffett's first year started out a little bit rocky. He only generated a 10% return, which was actually 8% less than the Dow. But then in his second year, he generated a 40% return, then 25, then 22, then 45%. He had another rough year in 1962 with only a 13% return, then a 38% return, 27% return, 47%, 20%, 35%, and in 1968, a 58% return. Now, I really want you to focus on 1968 here because this was coming out of a major recession, and even though Warren Buffett generated a 58% return, he only beat the market by 7%. And this is the big benefit of starting out during a recession. Because as we come out of the recession, the stock market is going to go beast mode. It's going to rise significantly. And if we are able to beat the market, we could generate a 50-60% return coming out of a recession, just like Warren Buffett did. Warren Buffett uses a very simple style called value investing. Pretty much anyone with basic knowledge of finance can do the same thing that he did. Warren Buffett said you don't need to be a rocket scientist. Rationality is essential. You need to have a stable personality. In other words, be patient, stick to your rules, and don't break them. Don't go chasing the hot stock that's popular this week. Don't go jumping into a bunch of risky options. Just be very stable, very calm, pick good companies, and hold them. And that is what we're going to do. So let's get into the 7 rules that Warren Buffett followed in order to become a billionaire. Rule number 1 is buy businesses, not stocks. When you buy a stock, you are buying a part of that business. And over the long term, the stock is going to follow the performance of the business. Now, in the short term, it could be quite volatile. The stock could go up, down 10, 20% in either direction. And that actually gives us an ability to take advantage of that volatility, which I'll talk about here in just a minute. But for now, I want you to focus on the long term, say 4 or 5 years out. And where is that business going to be 4 or 5 years from now? When investing, you should look at companies that are going to dominate the future, not the ones who are doing well today. Look for companies with high profit margins, a big competitive advantage, and the ones loved by their customers. If the business does well, your investment will do well. Rule number 2, most news is not actual news. What Warren Buffett was trying to say here is that in the short term, news is going to move a stock up, down, quite volatile. It's very hard to follow. In the long term, very little of that short-term news actually matters. So as you hear news about the stock, you want to focus on the news that's going to have a long-term impact on the company in deciding whether or not to continue holding it or to go ahead and sell it. Rule number 3, not everyone is trustworthy. In today's day and age, that means don't just buy a stock because some YouTuber is talking about it. You have to be able to do your own research, your own analysis, and make your own decision whether this is actually going to be a good company for the future or not. There will be plenty of stocks in this challenge that you do not agree with because you went out and did your own research and you're seeing something different or getting some belief about the future that's different from what I have. And that's okay. In fact, I encourage you to do that. I encourage you to go find your own picks that you want to hold for the next 4 or 5 years and make your own investment decisions. I am not a financial analyst. I can't tell you what to buy, what to sell. All I'm going to do during this challenge is show you guys what I'm buying. And if you want to follow along, you can. If you want to make your own investment decisions, I certainly encourage you to do that. Rule number 4, plan on holding forever. Time in the markets is more successful than timing the market. If you're buying a company, you need to give compound interest time to do its work. Now, this is where we're going to deviate from Warren Buffett a little bit and follow the path of John Templeton, another billionaire value stock investor. And the reason for that is what John Templeton and Warren Buffett did differently, and don't get me wrong, they both became billionaires in the stock market. But what John Templeton did a little bit differently is he would hold his stocks for an average of 4 years. He would wait for them to get up to fair value, and then he would sell the company and buy a different company that at that time was undervalued. So that's the path that we're going to take with this. Now, I still agree with Warren Buffett that if you buy a good company, you could hold that company forever and continue to generate great returns and beat the market. I also know from experience that great companies don't last forever. Take AT&T, for example, which cut their dividend last year and had a major sell-off. They're going to have a tough time recovering because everybody bought that expecting to hold it forever due to the high dividend. They cut their dividend. The reason to hold was no longer there. You got to get rid of it. ExxonMobil would be another great example. It was a darling of the stock market all the way through 2010, and then it absolutely crashed and did not recover again for another 15 years. It would have been far better to sell ExxonMobil, find some other value stock, and then get back in once ExxonMobil was a value stock once again. Rule number 5, no intrinsic value. In other words, know what a company is worth. Know what the company should be trading at. Remember, a company's valuation does not equal its stock price. The stock price of that company will almost always be much higher or lower than the actual company valuation or where the stock should be trading at, that fair value that John Templeton talks about. So what we're going to do is use some fundamental analysis to find the companies that are undervalued today, and then once the stock price rises up to fair value, we're going to go ahead and sell those and take our profits. Now, in the video that I'm going to be releasing in 2 weeks, I'm going to show you how to do fundamental analysis and how to find the true intrinsic value of the company or where the stock should be trading at so that you can go find your own value stocks to invest in during these next 10 to 15 years. Rule number 6, understand what you're buying. There are a lot of great stocks that may or may not be undervalued that people just don't understand because they're so complicated. Take something like Palantir, for example. Does anybody outside of the CEO really understand what Palantir does and how its business model actually works? I would venture to say no, because every time I watch an analyst or a YouTuber talk about Palantir, they all have a different version of what Palantir actually does, what business they're actually in, and what their growth strategy actually looks like. And the reason for that is because Palantir is so complicated. Their software is complicated, a lot of their clients are very secretive, and it's very difficult to understand that company. Warren Buffett says it's far better to invest in companies that you understand, such as soft drinks or car manufacturers, things like that, things that are simple and you know what they do and you understand them. Because a lot of times a stock might look undervalued, but if you don't understand the company and what they do, you might miss some major red flags with that company. So only invest in stocks that you understand what their business is. And finally, rule number 7, quite possibly Warren Buffett's most famous rule: be fearful when others are greedy, and be greedy when others are fearful. We saw significant greed in the stock market over the past few years. From October of 2020 through March of 2021, we saw amazing greed in the small cap stocks, with some of these growth stocks that were not even profitable hitting insane valuations. Some of the profitable companies were hitting PE ratios of 500 or more. It was an absolutely insane period of time. And then in March of 2021, through the end of 2021, it was the large caps that rose up to insane valuations. And everybody was greedy during this time. Now, I did jump into some speculative plays for very short periods of time to make some money, but then I went cash in October of last year because I realized that this greed just could not last. As everybody was greedy, I was fearful. And that is why I went cash in October of last year. What did Warren Buffett do? The same thing I did. He went cash. He put $128 billion into cash last year, and he literally went almost 3 years without buying a single stock once because he felt like the entire market was overvalued and it was going to come down. When others are greedy, you have to be fearful. Now we are getting into a time where everybody's fearful. Everybody's selling their stocks. Stocks are down 10, 20, 30, 50, 90% from highs. Everybody's fearful. What do? We are going to get greedy. We are going to go buy these stocks that are beat down dogs. We are going to buy the stocks that are falling knives. We are going to buy these stocks that nobody wants to touch right now. Because we know that once the market turns around and becomes risk on and everybody's greedy again, all these stocks are going to rise up to insane valuations and we are going to sell for a profit. So those are the 7 rules that we are going to follow during this Moomoo Millionaire Club Challenge. Now let me talk about where we are actually going to do this investing, because there was a lot of questions and confusion about what kind of account you could use for this challenge. First of all, if you're in the United States, you can use a Roth IRA for this challenge because the $5,200 per year that we're going to be depositing is below the Roth IRA threshold. In addition, you could use a traditional IRA if you wanted to go that route, or you could use a regular investment account. Now, if you use a regular investment account, you have to make sure that you're holding your stocks for a minimum of 1 year. That way, you can take advantage of the 10% capital gains tax instead of paying 30% or more, depending upon your income, if you were to do a short-term hold. In addition to that, I want to talk about what broker to use. If you're in the United States or Singapore or Australia, I want to encourage you to use Moomoo. Moomoo is the portfolio that we're going to use because Moomoo has some incredible tools and stock screeners that are going to help us find these undervalued stocks. In addition, if you sign up for Moomoo using my link in the description below and you get your deposit in before the end of this month, you got about 1 week left, you're going to get up to 10 free stocks. You get 6 free stocks if you deposit $100 or more, and you get 10 free stocks if you deposit $2,000 or more. So use my link in the description below to sign up for a Moomoo account and get your free stocks. It's an incredible boost to the portfolio. You could start your portfolio with $2,100, $2,500, $3,000, or even more dollars because of your free stocks. So it's an incredible way to jumpstart this journey. Now, if you already have a Moomoo account and you still want some free stocks and you're in the United States, then I recommend Webull, because Webull gives you 6 free stocks up to $12,600. Once again, if you use my link in the description below and deposit at least $1. And again, you got to do that by the end of this month. Now, if you're not in one of those 3 countries, if you're not in the US, Singapore, or Australia, if you're in Canada, Great Britain, something like that, then I recommend Interactive Brokers. On Interactive Brokers, you can have multiple accounts. So even if you already have an Interactive Brokers account, you can go open another account with them, or you can use whatever local platform you have. If you're interested in Interactive Brokers, then I have a link for that down in the description of this video as well. So those are the platforms we're going to be using. I personally will be using Moomoo due to the tools that they have available and the 10 free stocks. Real nice benefit. Of course, you can use whatever account you want, but if you're interested in that, you want to get your 10 free stocks on Moomoo, again, I have a link in the description below. I'd love to have you guys come join us. I look forward to being a millionaire with you in the next 10 to 15 years. Our patience will pay off. Patience, P-A-Y. We are going to get paid for our patience, and we are all going to become millionaires in the stock market by value investing over the next 10 to 15 years. I look forward to having you join the Millionaires Club with me, and I will see you in 2 weeks with our training on how to do our fundamental analysis.